Banks in particular are focused not on consumers this time. That was back in 2008. They're focused on commercial real estate. So commercial loans to small enterprises, anything connected with commercial real estate, multifamily real estate. If you look at Chicago, New York, Los Angeles, San Francisco, you don't want to own any commercial in those cities right now.
Do you have a timeline in mind for when some of that might play out?
It's right now.
Right now. Right now. Okay. Chris Whalen, chairman of Whalen Global Advisors, an investment banker, and also author of the blog Institutional Risk Analyst. It is great to welcome you back on the show and great to see you as always, Chris. Thank you so much for joining me.
Thank you.
Well, Chris, I got to say, the last time you were on, which would have been right around all of the regional bank failures back in the spring, you were an absolute hit with the audience. And I always love interviewing you. And I've interviewed you for many years, going back to my time at Yahoo Finance. And there's a lot transpiring today. So let's kind of start with the big picture. I imagine we're going to hit on rates as well. But I just want you to kind of set the table. What is the big picture view for you today where we stand?
Well, the big picture is the Fed is slowly killing the world of credit. We're in a situation where rates are rising and asset values are falling. The average bond coupon in the United States is somewhere around a 3. And if you look, those bonds are trading in the low 80s, high 70s right now. So that shows you what banks are dealing with. We will have a record mark-to-market loss for securities in this quarter because of the 10-year Treasury. The 10-year is 4.7 is where it closed a quarter.
Yeah. So is that, let me ask you this. Is that signaling to you, and I've seen some chatter on Twitter and whatnot, is that signaling to you that we're headed for trouble, that we could be headed for a recession? What do you think it's signaling?
I think it's signaling that the Fed is going to stop soon. If we see another bank failure, FDIC is not going to be able to find a buyer for the bank. That means that they will have to catch it, put it in conservatorship, and figure out what to do with it. If you look at how they dealt with PacWest, they're going to allow a smaller bank to buy that institution. It's not going to work. But right now in this environment, how do you get a bank to buy the assets of a failed bank if they don't know what they're worth? Banks in particular are focused not on consumers this time. That was back in 2008. They're focused on commercial real estate. And again, in a rising rate environment, when you have to find a buyer for these assets, it's hard to do. You know, most commercial real estate, Julia, going back our entire lives, right, only went up. And they almost always used interest-only balloon mortgages. Every 7 years, they would write up the value of the real estate. They would roll the mortgage and do it again. Right? So it was easy. Now the value is falling. So when you go back to the bank and say, hey, I want to roll our mortgage, it's year 7, they say, well, okay, but you got to put cash in. So you still have 50% equity. That's very hard.
Yeah. On the commercial real estate side of things, do you have a timeline in mind for when some of that might play out?
It's right now.
Right now. Right now. Okay. How about localities or where? I don't know, like what kind of details you have there, but where are we starting to see this?
Legacy cities are bad. And outside the cities, suburban real estate, it really depends on where you are. You would think that the Southeast, Southwest is very strong, and it has been. But you also have cities like Austin, Houston that really were overinvested, and they're now on the downside. So if you look at Chicago, New York, Los Angeles, San Francisco, you don't want to own any commercial in those cities right now.
I take it that we are not out of the woods here when it comes to the banking crisis that we saw back in the spring. Where are you starting to see those worries crop up? Or I guess, is it because we're about to get into earnings season? We're going to see more of an insight into, what some of these balance sheets look like. What do you think?
Well, we put a piece out today in the blog for all of our readers to kind of walk you through the top 5 banks. They're looking at another down quarter, so this will be the 3rd quarter in a row that net income is down. Why? Because they're earning less on their assets and their funding costs are going up faster. Okay? Even though you saw a nice increase in bond yields and coupons on mortgages, we're right in 7.5s now in residential mortgages. And the banks are buying some of that, but their funding costs have been going up faster. So net interest margin's been squeezed for the past 3 quarters. And I think what you're going to see is we're going to get through this year probably with flat income is my hope. And then we have to start talking about credit in 2024, which will largely be commercial. It won't be about consumers. You see all these people yelling about, oh my God, there's $1 trillion worth of credit cards out there. If you adjust that number for inflation, Julia, we're actually using less credit now for consumers than we were 10 years ago. And by the way, the default rates are very low. Banks have $4 trillion in unused lines out there that they would love you to use. So you should go shopping this afternoon. The banks are not showing any stress at all on the consumer side. Where the stress is, as I said, commercial. So commercial loans to small enterprises, anything connected with commercial real estate, multifamily real estate. Look at New York. The New York State Assembly has basically killed multifamily rentals as an asset class. And they think they're helping consumers, by the way.
Can you shed light on that? I am curious. I don't live in New York anymore. What happened there?
In 2019, the State Assembly, which is filled with unreasonable people who hate business, who think that landlords are the enemy, basically made it impossible for landlords to recover their costs when they rehabilitate an apartment. So let's say you've lived in a rent-controlled apartment in my old building on Central Park South. The tenant leaves, you have to bring that apartment up to code. You have to fix it, new bathroom, new kitchen, a little bit. That's $100,000, easy. The New York State Assembly won't let the landlord recover the cost. So these assets are dead, Julia, and the banks know this. The bank regulators know this. So for example, when Signature Bank, when FDIC started selling their rent-controlled buildings from that portfolio, the FDIC had to keep the majority position in the joint venture, because nobody wants them. These are dead assets. Cash buyers will buy these buildings. They will cut the costs. There won't be an attendant at night, things like that. And the quality of the rental will degrade. So what will happen over time is these buildings will turn into condos. So we'll have less and less and less rental apartments available for consumers in New York because of the crazy people who control the New York State Assembly.
Wow. Do you think, is that like an unintended consequence here? Or?
Well, they're pandering. They think they're pandering to consumers, to Democrats in New York, but they don't understand business and they don't care. They really don't care. The landlords tried to challenge the law in court, and the Supreme Court just declined to hear it last week. What I would tell you, if you own multifamily real estate in New York City, you should sell it for whatever you can get if it's a rental building, and just get out. Because these assets are unfinanceable. You cannot get a mortgage on these buildings now from a bank.
Hey, everyone. Thank you for listening and watching the show. I do want to share something with you all. And if you've been here since earlier this year, you've probably noticed that this channel and the content that we're putting out has improved. And I'm not talking about the interviews. I'm talking about the quality of the production. And I have one person to thank for that. And that is my wonderful producer, Matt Marlinsky, who is the founder of Marlinsky Media. So if you're someone like myself and you want to get started in podcasting, or maybe you already have a show and you want to level up the production, you have to work with Matt. Not only is he a super talented producer, he is a wonderful person, and there's no one I would rather build this show with than him. And he's also great when it comes to producing content. So if you already have content, he can help you create more short form to grow your audience. So definitely go check out Marlinsky Media. Okay, back to the interview. So you were talking earlier about, I guess, the issues cropping up in credit in 2024, and that is commercial, not the consumer. Can you elaborate a bit more on that? I do want to hear a bit more on that.
Well, a typical recession in this country, going back decades, right, was led by consumers. But this recession is being caused by the Fed. The Fed is trying to recoup their credibility. and also their virtue in a monetary sense, because they messed up in 2018. As you recall, the money markets almost crashed. In 19, Powell panicked and he started pushing down interest rates way before COVID, right? And in 20, they just opened the floodgates and bought $9 trillion worth of securities. There's so much cash in the system, the consumers are still coasting along on all the money that was put out there, both by Congress and by the Fed. The ones who didn't get help were people who owned commercial buildings that were empty. We had rent forbearance on rental apartments for 2 years. There's not many real estate developers out there that can miss 2 years worth of rent payments and survive. So the consumer was handled. You can still get forbearance. If you call your lender on the phone and mention the word forbearance, they'll automatically put you in the forbearance. So this is the consumer-centric world we have. And, again, auto loans, credit cards are not really showing signs of stress, except that kind of bottom 20% of borrowers, the ones who had problems during COVID, they're getting kicked around right now. If you look at the FHA, the bottom 20% of borrowers are in mid-teens in terms of delinquency rates. So I think it's a very selective recession we're having, because if you look at the middle and the top of this economy, Julia, you see any problems down there, where you're living in the Carolinas? No.
Yeah, okay. This is fascinating too. So if it's commercial side of things, do you think it's okay? Is there anything that can be done to, I don't know, prevent it? Or do you think I don't really know if that's even a good question. I'm trying to think if it's always typically been a consumer centric, but if it's commercial centric.
Yeah. Well, we subsidize consumers now. I mean, no one loves landlords, right?
That's what I was thinking is it's kind of, I guess there's this perspective of it's hard to feel sorry for landlords per se.
I think so. These are small businesses. If you deprive a small business of all of their income, and they still have to run the building, right? They still have to take care of their tenants. That's the key thing. If you're a landlord, you got to take care of your tenants. But if you don't have the income, you can't do it. And then you turn around to your bank and say, "Hey, can you help me?" And the answer is no. So it's very sad that the Congress was so willing to bail out consumers, and they never thought about the rest of the food chain, because we need a place to live, right? Think about all those consumers in Chicago and New York and San Fran that are now in a building that's essentially dead. They can't refinance it. It's hard to sell. The owner may walk away. You could literally see buildings in New York City get handed to the New York City government. How do you think Mayor Adams will feel about that? Because they don't want to put more money in. It's basic. Look, you've seen Blackstone. You've seen all of the big developers walking away from buildings.
Yeah. What do you think are some of the consequences of that too? Because if it's a recession, it plays out in commercial. I imagine it does have more ripple effects throughout the economy, right?
It does. You won't see it as much because commercial is a professional market. There are no consumers involved. So you have lawyers on both sides of the table. They look at one another and say, "Well, what do we do?" The first thing they do is extend the mortgage at current rates. They just keep paying, even though it's expired. And then they try and figure out a way to refinance it going forward. The trouble is that the analyst community can see the taxes, they can see the rent rolls, all the numbers that go into a commercial property. So that's all transparent. It's very easy to figure out what the building's worth because you look at what they make on rent every month, right? Investors, on the other hand, if you're coming to a new person, they're saying, "Hey, can you help me finance this building?" They want a higher return now. The cap rates have gone up from where they were 3 and 4 years ago. So they want 8, 9, 10% for their money. Pre-leverage, by the way. Mm-hmm. So, again, it's a more difficult market for a building owner to navigate.
Yeah. Yeah, I imagine there are people who are probably waiting for that opportunity too.
Well, it's a silent crisis because, nobody loves landlords. And these are private transactions. It's not like a consumer facing foreclosure, which is a very public event. In commercial real estate, when these things go bad, they're mostly negotiated privately. The lenders are involved, and they look for a solution, ultimately, is what they want.
Yeah, that's interesting. A silent crisis. I haven't heard that before.
Oh, we all need a place to live, right?
Yeah. But I imagine it does impact, it's going to impact probably some banks more than other banks. Maybe
Yes.
is it more of the regionals in this case because they're the ones who typically do these sorts of loans in a regional market?
It's hard to generalize. It depends where they are and what they have in their portfolio. So look at Bank OZK, which is a big national lender, small bank. It's only about $20 billion down in Little Rock. They do development lending, the front of the process, if you will, building a building, then they get out. If you have small banks that hold mortgages on existing buildings, it depends where the building is. Is it commercial? Is it residential? Is it fully let? Because even down south in some markets that are very hot, Julia, that have been attracting a lot of investment, you do have situations where the asset just doesn't work and it's losing money. So in those cases, they're going to restructure it. You wipe out the equity, people put new money in, and they keep going. In the Northeast, that's a more difficult conversation because do you really want to put new money into an existing building in Queens, New York, especially if you've got a hostile political environment? That's a more difficult question.
Yeah. I guess what are your thoughts on New York today? I moved out at the end of 2020, and now I've lived in Miami for a couple of years. Now we are in North Carolina.
Nice.
What's your take on New York?
I think New York politics have to change if the city is going to survive. You cannot finance New York City schools, all the services that people have become accustomed to, without a commercial component. The Dutch built New York as a place to do business. That's why it's in a grid. If you turn it into nothing but residential, your costs are going to be very high. We couldn't charge consumers enough to live in New York City without a business base. There's just no way to make the numbers work. And I think you see that in most urban areas today. We're going to have to rethink the cities because these cities were created in the 19th century. You know, the roads, all of the use cases for the major cities in the northern part of the U.S. go back to an age that's gone. You know, we make cars in South Carolina now. We ship them out of the ports in the southern part of the U.S. We don't use Detroit anymore. We don't have immigrants coming down the St. Lawrence Seaway. So all of these use cases have changed.
Yeah. Rethinking cities. Just to drill down further on the point of the Fed could very well push us into recession. I want to hear more on your thoughts there because you're mentioning that typically they're caused by consumers. This one will be commercial. Do you see a recession as inevitable, I guess, based on the path we're on? I have this debate on this show a lot where some people are saying it's 50-50. Some still think that we still have hopes of a soft landing. Others are very much adamant that we'll see one in the next 6 months.
What I would say to you is that this is kind of a really strange economic cycle in a sense that the Fed has had to shift gears 180 degrees, go from inflation's too low, remember Janet Yellen, to now trying to fight inflation in a way they haven't done in at least a generation. When you look at it that way, the last thing that's going to fall off the card is consumer. In fact, we could do horrible damage to the financial system and still not have a technical recession. Think about that. You could have bank failures in the fourth quarter, but we won't be in a recession.
That's hard to kind of compute, though.
Yeah.
Has there ever been a time like that in history?
No, because the U.S. hasn't been in a position like this, where we went through an extraordinary external event, COVID. The response was excessive. And now we have a federal government that's up to its earlobes in debt. And that debt causes volatility in the markets. So who buys debt? Banks. Banks buy treasury bonds. Banks buy mortgage-backed securities. And what's happening is that part is in big trouble, but the consumer still looks fine.
Yeah.
You know, half the banks in this country are probably insolvent, Julia, if you mark them to market.
So mind-boggling to think about, like on the mark-to-market, half being insolvent.
But the regulators are sitting here talking about raising capital when the cause is the Fed. There's this big disconnect between reality and the appearances that we see in the narrative every day. You know, the regulators, the Fed, they're all trying to keep us on message in terms of the pre-COVID narrative. but it doesn't fit anymore. And I think people realize this.
That's fascinating too, the messaging, if you will.
You know, the Fed wants you to believe that they're in charge. They want you to believe that there's two people sitting in the cockpit and they're driving the plane. But the reality is that the Fed makes this stuff up as they go. You know, scientists follow the rules of science. Fed officials make up the rules to suit the outcome that they want. And that's a very different thing.
Yeah. When it comes to banks, I've heard you describe that banks are really, they're much more like, and I don't want to botch your quote, it was much more like a fixed income trade that masquerades as an equity trade. So given what's happening in fixed income, would you want to own banks? Or is that a place to even like want to be in?
No, I have come and gone on banks. Back in 20, I sold most of my common and bought preferreds, which was a very good trade because the preferreds were trading at a discount. I think now, you know, the street after COVID rushed into banks. They thought, oh boy, everything's fine now. But they forgot that we were still adjusting from the volatility of that period. So now we're in a year where income's going to be muted and down. So most people on the street are not looking to add exposures when it comes to banks. I think you want to kind of keep your eyes on most banks for the next year or so. If you want income, you can buy the preferreds, but I would be very careful with the common because there's a lot of good banks out there that have only one problem, which is mark-to-market accounting. Schwab. I love Schwab. It's one of the lowest risk, best funded banks in the top 25. But you know what? Half their capital's impaired as of the second quarter. When we see the mark-to-market in the third quarter, it's going to be ugly. And that's why, by the way, good news, Julia, I think the Fed's going to blink and the Fed will be dropping interest rates before the end of the year.
Because
of the
what
banks.
they'll see. Yeah.
You have one bank failure and they can't find a buyer because rates are rising and asset prices are falling. The Fed's going to have to blink and they're going to have to retreat.
I'm going to ask a really naive question. I know it's a naive. Should we have mark-to-market accounting? Does it make sense or not make sense?
It was, remember after 2008, everybody thought, well, we'll go to fair value accounting and thereby we will find truth. But the reality is that finance is not a photograph. Finance is an oil painting, okay? And they show you as much as they want to show you, but not anymore because it's a managed version of reality. You can't really use mark-to-market on a bank. You can use it on a broker-dealer like Goldman Sachs. And by the way, Goldman doesn't have a mark-to-market problem because they're a broker-dealer. They trade stuff every day. Banks are long-term repositories for value. And when you impose mark-to-market accounting on them, I think it's a mistake. Having said that, the little banks I love mostly keep all their securities available for sale. So they're always mark-to-market. That's their discipline. And they also keep that treasury portion of their balance sheet less than 5% of the total. They don't want problems. It's not like Silicon Valley Bank where we had 40% of total assets in mortgage-backed securities, which had a zero risk weight for Basel, by the way. But it still killed the bank.
Let me ask you, I know we don't have much time left, but I want to ask you about housing. I want to get your kind of housing market outlook. I'm asking as a selfish millennial here who would, gosh, I'd like to buy a house, but I also am like, it doesn't feel like the right time, especially with mortgage rates nearing 8% and like there's like no supply. It is crazy. It is so crazy. But what's your big take on housing?
Well, the supply is muted. Home builders are very cautious because, you know, when we got through the boom during COVID and prices started to stabilize or go down in the high-end homes, those are where they make money. Builders don't make money building $200,000-$300,000 homes because they can't add enough value to increase the profit. Now, this year, because of interest rates, we're not even going to do $1 trillion in mortgages. We did 4+ in 2020. So a huge swing in financing. The bottom half of the home prices are not going to move very much because there's no supply. The top half are going to compress. So what you saw, you know, within the last couple of months is that the hard money buyers who are out there buying jumbo loans that are too big for the agency market, have kind of gone from buying 5s and 10s down to 2s because there's less compression, less price compression for that $2 million house than there is for that $10 million house. And right now, everybody's worried about value. They're worried about loan to value rates because that's kind of, as a lender, you go out and finance some sports celebrities $10-15 million home in California. You only want to be in there for half. You want half equity from them. Many times they'll do interest-only mortgages on these properties. But again, as a lender, do you want to take the risk of that home price getting compressed in a recession? No. So, if you're down below $300,000, there's lots to pick from, but not enough supply to really meet demand. And then above that average loan size, you're going to see price weakness over the next year or two. But then,
so maybe it's better to wait for someone like myself.
No, if you have to buy a house, you could get a floater. Keep the floater for a couple of years, and then when rates fall, refinance yourself into a fixed rate mortgage. That's a good strategy.
But when you talk about some of the prices coming down, you're not talking about like a full-on crash by any means, right? Just maybe coming back to more reality.
Yeah, we'll take some of the air out. Look, there were a lot of markets around the country, I'm sure you've seen this, where vacation homes suddenly became residential properties, and the entire backlog in places like Whitefish, Montana disappeared. Now, we're not going to replace these houses. They're not going to build any more of them. So the inventory is gone. Prices went up as a result. Now they're softening. It's the age-old cycle, right? Everybody was running out of cities during COVID. Now they're coming back to some degree. But I would be very cautious about buying urban real estate right now. I think a lot of my friends who jumped into New York, for example, in 22 made a mistake. They thought they got a deal, but I don't think you want to be trapped in that mess until we figure out the politics.
Yeah. Well, I got to say, Chris, I always love talking to you and learning from you. And I want to give you a few minutes if you want to share where folks can, maybe it's follow you on social media, read your blog, Institutional Risk Analyst, anything you want to plug in, any parting thoughts you have for the folks, things that we didn't bring up in this conversation, or maybe things we did bring up and you want to reinforce, please take the next few minutes to do so.
Sure. I write the Institutional Risk Analyst blog. I also write a column for National Mortgage News. I spend a lot of time with mortgage lenders. It's a very, very important part of the U.S. economy. And the non-bank lenders are going to inherit the earth if you look at what's happening with the new capital proposals for banks. When you want a mortgage, don't call a bank. Call a non-bank. Call Freedom. Call Mr. Cooper. Call any of the other non-banks because they're going to give you better service. Rocket, PennyMac, take your pick. What I do as a banker is mostly in the fixed income world, financing, that sort of thing. And of course, you can follow me on Twitter, RC Whalen. We have a great time on Twitter. And, I appreciate your time, Julia.
I love it. Well, Chris Whalen, Whalen Global Advisors, chairman and author of Institutional Risk Analyst, and of course, an investment banker. It is so great to see you. I really appreciate you taking the time. Thank you again, Chris.
All right. We'll do it again. Thank you.